Hey guys, welcome back to the channel. I hope everyone is doing okay. So I'm in a undisclosed location and I hope the sound quality won't be too bad. So I want to return back to like the return on capital issue because it's been bothering me for a while and I meant to get to this from my last video, but it turned into like something else completely. So return on capital it's a really annoying problem for high yield investors, but why can't ETF companies fix it? Unfortunately, there's not a lot of good resources out there, but I did manage to find two that I thought was somewhat decent, so I'll share this with you. So first off, you have to kind of learn about like the ETF, like the birds and the bees. So ETFs don't just like come out of nowhere. It's not like you and I can like just buy a whole bunch of stocks or do a whole bunch of like option trades and then like try to sell it to the public. There's a lot of things that go on in the background. So basically, like there's something called the creation and redemption mechanism, and each time you create like a what they call a unit, and in order to create like these ETFs, like you have to kind of like it's almost like a initial public offering in a way. They're usually each time like there's like a lot of demand for like a certain ETF, they have to create these units, which are usually done in blocks of 25,000 shares, and they can only be done through authorized participants. And just as an example, YieldMax, like if you look in their website and you kind of like scroll around, you'll see something like this where they kind of advertise like their, I guess, like so-called authorized participant partners. So which makes sense. So anytime like you buy like a ETF, like for example, I'm on either TD Ameritrade or Tastyworks, and I go through, since the TD Ameritrade and Thinkorswim platform is under the Charles Schwab umbrella, it kind of makes sense why, for some reason, I find like it's easier to fill on Thinkorswim rather than Tastyworks, and I'm guessing this is probably one of the reasons why. So also the article that I'm referencing is also in the link in the description below, and this was a nice chart. It kind of like outlines like the kind of like the workflow. So like you and I, like every time we're buying and selling YieldMax or Defiance or Kurv Invest or Rex shares or whatever, like first we have to go through like the broker dealers, which is basically like for example, your whatever you're using to trade stocks or options, and then it goes to like the exchanges, which is like for example like the New York Stock Exchange, Nasdaq, etc. And then it goes to like these authorized participants and other market makers, and then like just based on like what like depending on whether they're buying and selling the ETF, then there's like we have to give them like these guys have to give them the underlying securities. In this case, like for YieldMax, it's actually like options. Most of the time, it's a combination of like either stocks, bonds, or something like that, and they give them to YieldMax directly. In this case, this is Charles Schwab, but they also sell ETFs as well. So you can replace this part over here with YieldMax, Defiance, Curve Invest, Brex shares, etc. And then in return, they give these guys like for example, like let's just use like Tesla as an example, like TSLY, and then from there it goes through like this whole process to get in our hands. And you'll notice something interesting here, like the creation process, like through the securities and ETF shares. There's an arbitrage opportunity for like these authorized participants, and this is why I always harp on you guys like that. Whenever possible, try to buy like your like let's say like you're accumulating Tesla or triple QY or whatever ETF that you happen to have an interest in. Always try to buy at like the net asset value or lower, because like what happens is like if there are times in the past when like I've also shown you guys like the premium and discount graphs that anytime there's like a premium, there's an opportunity for them to for these authorized participants to just like, well, for example, if it's trading over the NAV, like you can actually go back to YieldMax or Defiance, give them like whatever's overvalued, and then like kind of like redeem. So let's say for example, uh, like your Tesla, it's supposed to be worth $10, but then like if it's trading at like 990. 9.95. There's like a 5 cent like arbitrage difference. I remember these guys aren't playing around with like 100 shares. Like you if you multiply that out by like whatever number of shares are trading outstanding, that they can actually add up over the course of the year for like these authorized participants. So that's why I always tell you guys try to buy at net asset value or below. This way, it's like you don't like leave some money on the table for yourself. And then just in general, why the return on capital issue can't be solved. Unfortunately, this is due to like this is a unfortunate problem for most retail investors, especially if you're like around like retirement age. Hopefully, like by like let's say like you're 65 or older. Hopefully by then you have a chance to have accumulated like a high six-figure balance, and I really hope that you're able to accumulate at least like seven or more. Right now, like a lot of folks are kind of in like a tough spot just because like maybe there was like an unfortunate accident or medical bill or whatever. And right now, people are really desperate for a livable yield. And unfortunately, I think this is why people tend to crowd into like these high yield names, just because like one they I guess like just naturally will attract a lot of attention. But I would caution people to just be careful. Don't plow everything in at once. Because even like there's like these so-called conservative high yield funds, and they still will have like these return on capital issue. And just for example, and then there's also like the problem on the other side for like these ETF issuers. There's like these every day there's like creations and redemption orders, and this really creates a problem because like let's say you're trying to plan ahead. Let's say like you you originally had $100 million to like work with, but then like because like a lot of people are coming in to like cash in, and now your balance is down to like 90 million. That's less money that's being able to put to work for like say for example like option trades. Let's say like you're like the like Zega, they're trying to plan like these option trades for like Tesla or Coney, but then they don't have a maybe they don't like they're creating like a suboptimal trades for themselves, or even worse, like maybe all of a sudden like people pile in and now they have all this like cash to work with, but then like let's say for example like the Coney, sometimes like people pile in like at the wrong times, and then now they like, let's say like you're fighting like the market now, like let's say like the market is going down and originally you had a synthetic long, and now that synthetic long is now worth less. Even though you're making some money on like the short call, now your actual capital base is actually eroding a little bit. And then the second thing is like just for especially for like the option based ETFs, volatility forecasting is extremely difficult. And if, maybe in a future video I'll explain why. Especially now like the just like the volatility in general is collapsing. So this creates like a serious issue, especially for like these like the big guys like YieldMax and Defiance and Curve Invest. And I also want to just bring up like in general, even the ETF kings have this issue. So the BlackRock TLTW suffered asset depreciation, and and they had to resort to like return on capital to maintain their investment yield. So I took this off of like the latest like annual report, and as you can see, like there's a net decrease in net assets resulting from operations. So it's like they suffered like 97 million decrease, and as you can see, they still managed to pay out like 33 million, and 3 million of that was return on capital. And just as a trivia, like I once interviewed with like BlackRock for like a bottom feeder job. Like so this is like a low level analyst job like way back when, and I still couldn't get it. Just shows you like how stringent they are in terms of weeding out like candidates to work for them. And another ETF king. This was a little bit surprising too. So I found this article. I don't. and of course like this is shared with you in like the description below. So even the fuddy-duddy like Vanguard has this problem as well. Even though like they're although like I would say like the return on capital is probably more at like a conservative rate. So according to this is like Vanguard's Canada division, and one of their ETFs like was only able to like generate 2.4% a year in income distributions, with the remainder of the 4% payout coming from capital appreciation. So this is like part of the issue where like even as like a really conservative outfit like Vanguard, like they have to resort to like capital, like a return on capital to kind of like meet like investor demand. And then there's also like the net asset value. I guess like in general, the like this is like a term that Jay brought up in one of his previous interviews. So it's actually not always like so-called NAV erosion. This is actually like a net asset value lag, and this is caused by like settlement delays. So first, like for example, if we wanted to put our money to work, like we'll first have to go through it by buying it from like the our brokers, and in turn they go through that process that I showed you earlier, where they go to the authorized participant, and then they go to like to either YieldMax, Global X, or Curve Invest, etc., to put that money to work, and then the ETF themselves like will have to deploy cash into like an option strategy. So even if they're using like a T+1 settlement, like so for example, like whatever like the time of like your transaction, you have to wait at least a day. And this causes like reporting and execution delays. So I would just say like in general, the I guess one way to like kind of work around like the return on capital issue is that like maybe you should consider like layering in. Don't blow your load all at once at the same time, because this way you can put your money to work at better prices over time. Because I notice like some people are having a tough time right now, especially with like names like Tesla, and there was like another one that was pretty popular at one point. There was something called CYA that I covered way back when, and unfortunately like CYA, I guess I'm kind of fortunate. I never got a chance to like to buy into it, and because I was looking for like a long volatility fund, and unfortunately that fund was I'm guessing it's probably even worse than Tesla in terms of like the NAV erosion, or I guess like I should say like the net asset value, just like the depreciation. It's so bad. The last time I checked, one viewer mentioned that they have to do like a 20-for-1 reverse stock split soon. So again, guys, just be careful out there. So I guess like in general, anytime you see like a 20% drop, that's kind of like a warning signal. So, you know, just like be careful and don't rush in like all at once. And just like over the course of like, the research, like I kind of want to give Global X like an honorable mention. They have like pretty good disclosures. So if you go on the website for each of their covered call ETFs, you see like a nice long history of like the return on capital. And even for them, like some of the like QYLD, I wouldn't say would be like an extravagant like ETF, but even then, like they have like return on capital like as high as like 50%. Like I was just like spot checking like the prior years, and there's I guess there's just no really good way to get around it. So I guess like in general, I would still say like the high yield ETFs are, I guess like they're relatively easy to understand, and I think for most investors like it saves some time because like I think it's a good way to outsource like at least part of your investing or trading, and I think like over time you might be able to escape after some years, assuming you're being prudent with your purchases. Of course, like the usual risks are like there's no guarantee of like a full recovery back to like whatever the original starting price was. Uh, we don't have any control over like the option strike selection, and they sometimes like the cover calls are a bit suboptimal, but nobody gets it perfect. And as I mentioned before, implied volatility could collapse, which means like there's less premium collected. And And then of course like we also have to watch out for high yield tourists. Sometimes like they just jump in and plow in without thinking, and unfortunately that causes like the like for each individual person like the net assets is like we're getting diluted. So just be careful with that. If you like this type of content, please consider giving this a like. I appreciate all my subscribers so far, and I hope everyone makes some good money out there. 2024 should still be a good year, and I'll see you in the next one. Bye now.